Okay. Hi, everyone. Maneko64 here, home of alternative economics and contrarian views. So I decided to do this live stream because I've noticed that, and probably you as well, that volatility is greatly increased. It's not just the yields spiking a lot higher, but the volatility of it as well. So Billy even joined in. I had to go pick him up upstairs. He wanted to go to sleep already. I see. Yeah, I just thought it was important to do kind of this, like, kind of an emergency, really, because I spoke a few weeks ago that we needed to keep an eye on Treasury yields because if they got as volatile as they did last year in March, I would be concerned. And I think the bond market is starting to lose confidence in the Fed. Confidence is starting to crack. I'm going to look at an article here from Zero Hedge that came out, and I'm not surprised because the US Treasury market is a market that I used to deal in for like 20 years when I was a futures and options broker in the city of London. I was a bond broker. We dealt in Treasury futures, not just US Treasuries, but other government bond futures. And I'm very familiar with all the auctions that the Fed has and all the terminology. And I think it's really important to show you, you guys, this here. So as you can see here, Zero Hedge, Treasury yields explode after catastrophic trailing 7-year auction. So US Treasury auctions, they usually come out around 1 p.m., the result, just after 1 p.m. New York, 6 p.m. London. I even remember I used to leave the office at 6, but I had a client that used to deal a lot in treasuries, and he was in London, but he was gone. He had gone home already, and I had to stay past 6 o'clock to check the results. So this is what it says here: Treasury yields explode. So this is as close as to a failed auction we have ever come. So what is the bid to cover? Well, that's how many more bids than there are bonds offered. In this case is the 7-year Treasury note. And you notice that the bid to cover is 2. So that means that there's 2 times more bids than offers. And you'd think, well, that's fine then, because I've seen auctions of German bonds or Italian paper where the bid to cover is below 1. So why is Zero Hedge making it seem that it's catastrophic? Well, you have to come down here to the internals, as they say. It says the internals were ugly, with indirects plunging from 64.1% to 38.6%. So what are indirects? Well, they're basically foreign buyers, real investors. So who came to the rescue then? Well, it was the direct bidders, the directs. As you can see here, we go down here, it says, and with the collapse of indirects, the directs taking down 22%, the highest since June, perhaps simply because there was no indirect demand. Dealers were left with a whopping 40%. So the dealers are the primary dealers. The directs actually, sorry, I made a mistake. The directs are just investors out there. The indirects are like foreign investors, foreign treasuries. So what this is meaning here is that almost 40% of this was bought by primary dealers, the highest since 2014. So this is very serious. I will go over the charts of the 10-year, the 7-year, and the 5-year as well. So I also want to show you the who the primary dealers are. So you will realize that it's actually the Federal Reserve. It's the Federal Reserve who's helping out here. It's not the market. So let's share this here. Let's go and see who. So we've got here the Federal Reserve Bank of New York. They're the biggest, of course, regional bank, Federal Reserve Bank. They're a private bank. And if you look at the Fed's balance sheet, they've got most of the assets. They're the ones doing the QE the most, the New York Fed. So primary dealers, these are the people bidding directly in the auction. Indirect are people who give the bids, they're clients of these primary dealers. So these people had to step in. And buy 40% of that issue. So we've got BNP Paribas, Barclays, Citigroup, Credit Suisse, Goldman Sachs, all the too big to fail. But you can bet that the Fed, after they bought this 7-year note, this new issue, the Fed went in and probably bought these notes from these people. So this is what's happening. These people had to bail out the market, but it's really, these people here, the too big to fail, these dealers, primary dealers, but it's really the Fed that's bailing out the Treasury. And I saw one of you guys made a comment. And by the way, thank you for being here. And I think it's really important. I will take your questions as well. Why the bond market is so important for every asset class. Someone said that, that the Fed has just started QE at 161 yield in the 10-year note, and I kind of agree with that person who made that comment. So why are Treasury yields so? Well, someone is saying this is so confusing. Okay, let's just quickly go over a basic bond lesson, fundamental bonds. Bonds are just loans, securitized loans. And the U.S. Treasury is the biggest borrower in the world. So they have to issue loans every week, almost every day now. So these loans are called bonds. And the higher the yield they have to pay, the lower the price of bonds are, the more costs they have. And yes, it's not a good thing. And the Federal Reserve right now is trying to keep interest rates and yields low, and it's not happening. So this is very serious, because what the US 10-year yield and other Treasury yields, they're benchmarks for borrowing rates in all kinds of asset classes, stock market, corporate bonds, everything, commodities to some extent, but derivatives. So the higher the yields go, the higher the discount rate which people calculate the present value of stocks goes. And that means the price has to adjust lower. So it could affect everything. But one of the most important things, and we'll go to the volatility aspect of this, because I think this is really important. So I'm going to bring a chart here of the 10-year yield. So I'm going to share it with you guys. So this is what happened back in last year in March and April, when the Dow dropped like almost 40 points, the stock market. We saw a huge collapse in yields because people were kind of moving. They were concerned about things getting, they went to it as a safe haven. But at the same time, you can see here, yields went from 0.3 to like 1.3 in a matter of weeks, which is huge. Believe me, this is huge. I don't think I saw as much volatility as I did in this period. And that's why the Fed had to come in and say, we're going to do as much QE as we need. We can do infinite QE. Yes, they're stuck at 120 billion. And I've been saying now, because I told my viewers that we needed to look at this level here, which is around 130, which was the high during the crisis. And I remember, we broke through there a couple of weeks ago, and someone said, "Oh, nothing's happening. You said all hell would break loose." And I said, "Well, give it time." And lo and behold, it's starting to show cracks. So this is what is worrying here. The fact that we made this huge spike here intraday. So we went from a low of like 137 to a high of like is this the 10-year? Yeah. Yeah, this is wrong because we went to 161. So let's bring, this is not right. Don't know what's happened to the chart. Let's try to refresh it. Because this is wrong. We went up a lot higher. Well, we'll look at, okay, we'll share something else here. Okay, here we go. Okay, this is better here. So you see here the 10-year right now at just below 150, but we've been as high as 161. I would think that happened probably when the result of that 10-year auction came out. So this is like a 25 basis points move from low to high in the day. That's the volatility. The most worrying thing for the Fed, I think, is the fact that this volatility is starting to show in the lower maturities. They shouldn't be as volatile. If you look at the 5-year here, the high was a 0.865 today, and the low was 0.61. So it's like 25 basis points volatility in the short ends in 5 years is very significant. Not so much in the 3-year, as you can see, and in the 2-year, but because the Fed has more control of the shorter term rates. But this is not good either here because the 2-year note has been stuck around 0.11 lately, and even the 2-year is moving. So this is not good. The 7 years, you see, we've had a 26 basis points move within the day. So that is the volatility I'm talking about. Yes, the stock markets, of course, they dropped quite a bit. Let's have a look at the stock market, where we are right now. Just bring up my, so I'll share this with you guys. This is IG. So here we go. So yeah, what about gold and silver? Of course, am I concerned about gold and silver? No, I actually feel very comfortable about having gold and silver here. I think silver has actually done really well today. I know it's down 1.6%, but on a day like this, you would expect, in the past, silver would have probably gone down like 5-6%. The fact that it's holding here, it's even outperforming gold, is very positive. Gold hasn't made a new low either from the recent lows. I think what Jay Powell said yesterday is starting to worry investors. Jay Powell doesn't seem concerned at all about inflation, even the 25% increase in M2. I talked about that in my video. So with that, let's look at some questions. Sorry, someone asked about Harry Dent, Monaco versus Harry Dent. Yeah. Hi, Grow Mechanic. Nice to see you here. Sorry if I haven't looked at 10-year yield will be above 3% by May. Well, you've seen Gavin, what the trouble the market gets into when yields spike as they have today. Yes, it's going to get very interesting. The Fed might have to intervene. How could they do that? Well, they could announce with the Treasury yield curve control. They could announce more QE. And I think no matter what happens, I'm comfortable with gold and silver because people are losing confidence in this system. And I think this is what the volatility in bonds is very serious. And why is it serious? Well, because Wall Street and the whole financial system is highly leveraged. That means they leverage everything, even their treasury holdings, all bond holdings. And why do they do that? Well, because yields are so low still that they have to leverage things to get a return for their clients and for their speculation. So we just gonna have a sip of water. Yes, there was also, of course, the failure of something at the Federal Reserve yesterday. The whole payment system collapsed. Some people think it's technical. I think there's more to it. I think there is something deeply wrong within the system, within the plumbing of the financial system. So yes, I feel very comfortable having my physical stash of silver, gold. I'm not letting go. Yes, it's been very frustrating, but we need to batten down the hatches, I think. I think things are pretty precarious right now. The Fed is between a rock and a hard place. So I'm going to look at some questions here. Deutsche Bank going down. Well, the thing, I think all these too big to fail banks would go down if one of them went down because they're so interconnected. I saw as well something that could be worrying, not just for European and UK banks, but American banks as well, the too big to fail. It looks like there's a dispute now between the Bank of England and the EU. The EU wants about 100 trillion of derivatives. They want all the clearing for that to move to the EU, even though it's mostly done out of London. So 100 trillion, that's like 4 times the US economy. That's 4 times the EU economy. It could be something serious as well. And it could hurt not just the too big to fail European banks, but the American banks as well. And you might say, what's that got to do with the American banks? Well, they're involved in all these derivatives as well. They're interconnected. So Aaron says the 10-year yield now is going up to 151. Oh, I'm going to show you guys here because I can get, let's see, the 10-year note. Let's see how it's doing here. Bring up a chart. Taking a while to, come on, here we go. This is the daily chart of the 10-year. This must be a new one. Yeah, it's not a very good chart. Let's get rid of this. But anyway, let's quickly have a look again where the yields are. Yeah, I think it's very important. So yeah, here we go. The 10-year is back up above 150. As you see, it's been as high as 161 today. There was a very bad auction of 7-year paper. 7 years now at 117. It's been as low as 1 and as high as 126.60. So yeah, I don't think it's out of the woods yet. I think we need to be very patient with our holdings. I think it's for financial survival now, holding on to your precious metals. I don't think the price matters anymore, to be honest. And we can see that the real prices for physical is completely detached from the paper prices. How much silver should one hold? Supreme Overlord asks. Well, Supreme Overlord, each person, each individual has his own circumstances or her own circumstances. I would think of it as savings. How much would you want to save for a rainy day? That's how you have to think about silver. Tony is saying 1,000 ounces or more. As I said, it depends. 1,000 ounces in some countries could be more than enough. In some countries, maybe not so much. Jordan Mole says, sorry to be a broken record. What did you say, Jordan? I didn't see your comment in relation to that comment. 5,000 ounces of silver for starters, 500 ounces of gold. Well, that global intelligence, yeah, I don't think everyone can afford that, but as much as you can get. And I would probably favor silver a bit more, even though silver has outperformed gold quite a bit since last March. I mean, the gold silver ratio was at 127. It's now, I'm not sure, it's probably around just below 70 at the moment. Yeah, Silver Eagle says, who else bought it at 16? Well, I was able to buy a few coins last March, the day it dropped below 12. But I think it doesn't really matter if you buy it at 20 or 25 or 30 or 35, because I think gold and silver, especially silver, are going a lot higher. And by that, I actually mean that I think fiat currencies are going to drop a lot. Bernard Guillou, will JP Morgan paper finally meet Basel III requirements after vacuuming the market at artificial low prices? We'll have to see. I mean, the Basel III rules doesn't say you have to have the gold. It says that it is considered a tier one asset and you might want to have it. Yes, they might use the gold to because the problem with the Fed's balance sheet and the balance sheet of all the major banks is that they have a lot of treasuries or a lot of mortgage debt, bonds. And if yields start going up, the value of their assets start dropping and their balance sheet is going to be severely affected. So yes, the last resort would be to allow the price of gold to rise to pad the balance sheet. And I think that's what is going to happen eventually. Can't tell you when. Boom de clap, hi boom de clap. Are there still wheelbarrows left in the stores? I was listening to Jim Sinclair a few months ago about this question about deflation, hyperinflation, or inflation. And I think what we're going to get, and I think he's right, we're going to get lower prices of things like that aren't really a necessities. Things like I was walking around town today. I haven't been going out that much because we're still under lockdown, but I had to go to the post office. I went past a bicycle shop and all the prices of the bicycles have been dropped massively. Not massively, but quite a bit. And I thought of that. Yes, prices of things you don't really need, Tesla cars or things that are not necessary might drop, but prices of necessities like food, energy, rent, travel, everything like that is going to go up. And we're going to have the inflation or even hyperinflation there. And prices of financial assets, paper assets, they're going to drop as well, I think. And even if they don't drop, they might hyperinflate. If the Fed continues to pump money into the system, it's a very crazy situation. And that's why I feel very comfortable with having physical gold and silver. The miners as well, I'm comfortable with it. And I'm not trying to tell people what to do here. I'm just telling them what I'm trying to do and what I think is right, because I really think this system is really, they will never be able to pay back any of this. And even higher taxes are not going to do any good because it's going to put a lot of pressure on the economy. So yes, they come out and they talk as if everything was normal because they want you to stay in the game. The Viking, thank you for your super chat. The Treasury is going to unwind around $1 trillion. Yeah, I've read about that. What they're going to do, And some people think because they have over $1 trillion at the Fed's general account, the Treasury account, and it's the money that they haven't, the cash they haven't spent since the all the programs last year. But they're supposed to take that, to spend that cash, and I think they're going to start at the end of March. And what that's going to do, they're going to buy T-bills that are maturing. That doesn't mean they're going to pay off the debt, because they're running a huge deficit. All it means is they're going to shift a lot of the borrowing from the short end, from bills, and 1 week bills, 1 month bills, 3 month bills, 1 year bills. They're going to shift all that towards the longer end, and I think that's one of the reasons why yields are going up. And some people are saying that even the money market rates or short-term bill rates could actually go negative, because the Fed is going to hoover up all these, they're going to retire a lot of bills, and they're going to be issuing a lot of longer term paper. It's just a mess. It's something that's never happened before. So it's crazy. So the Dow now is down 395. I think it's been down quite a bit more. So let me bring up my the markets here. I'll share it with you guys. So yeah, right now we got the Dow futures down 380. It's at 31,570. It's been as down as almost 600 points. You can see, if you see here, the low was 31,360. The NASDAQ, though, is down 2.7%. You can see here, 12,940. It was down almost 500 earlier. The S&P is down 1.8, as you can see, 3852. It was down as much as 100 points, so it has recovered. Gold and silver, they're down, but they haven't gone any lower. And I think silver is doing really well. We're still almost at 28, and all this is happening. I think it's quite positive going forward. Let's look at the commodities. Yeah, we're seeing copper. I think it was higher today. It was around 430. We're down a little bit. Crude oil is at 63.40. So what about the banks? JP Morgan, I wish it was down quite a bit more than just 0.7%. Goldman Sachs is actually up on the day. So oh, Pablo Pina just got in. Lori Chioff says, I would buy PSLV. Yes, PSLV, there is an amount that you have to buy, and you can't just buy one share and get 1 ounce. I prefer really the physical. We should really be buying real physical. Yes, I think you can trust Sprott, Eric Sprott and PSLV, but I think the only way to defeat really the bullion banks and the system is to hold on to your physical for starters, and keep accumulating physical silver and gold if possible. Brown's boy, never buy silver or gold. Okay. I guess you're in the wrong live stream, or maybe you're joking. Fast Eddie. Yeah, Fast Eddie. I've been buying gold and silver for about 20 years, and it served me well. I mean, when I started buying gold, price of gold was like 200 pounds an ounce, or $300. Now it's over 1,200. So yes, it's come off from the highs, but as I said earlier in this live stream, we need to really be concerned about having actually real gold and silver, because I think the financial system is starting to crack. We've been talking about that for months now, And I think the Treasury market is where it will all, I think it's is it the fifth or sixth pillar that Jim Sinclair used to talk about, that for a really huge bull market in precious metals, you need to see bond markets in the bear market. And I think that could be starting. Yes, the Fed might come in and print to infinity and buy bonds and keep yields low, but that's really going to hurt the dollar. It's going to put a rocket up commodity prices and especially precious metals. So either way, I think they're between a rock and a hard place. Cupid stunts, yes. Foreigners, the bond market is not just Americans. It's there's all kinds of people are selling, domestic investors, foreign investors. There's some buying as well, but mostly it's the primary dealers. And you saw that the primary dealers also, there's some foreign primary dealers there. But the Fed is actually, they can't directly buy from the Treasury in the primary market. When the Treasury issues in an auction like they did today, the Fed can't buy. So what they're doing probably is buying now from the primary dealers that had to buy 40% of the issue, which is huge. That's just shows that the Fed is really having to monetize that. Yes, I really think there will be hyperinflation now. It's just a matter of time. And I don't mean a year or two. I mean weeks, months. We're very close, I think. And very few people expect hyperinflation. They don't think it's possible. And that's when it could happen. Erasmus, thank you for your super chat. Good job educating the worldwide public. Oh, thank you. The Dow now is down 426. Thank you, Sam Walker. Yes, I mean, we like Semple says, I guess March will be month. Not sure what you mean by that. I think it will be, of course, very volatile in March. After all, we've only got today and tomorrow, the last trading days for February. Monday is already going to be March. Doogie, thank you for your super chat. In a world where physical forgery is rife, especially when fiat collapses, won't this give Bitcoin the edge over precious metals? Leverage Chinomera. Well, the thing about that is that you have to deal with reputable dealers. And yes, there's always the danger that something could be forged. And that's why it's probably best to buy the small coins like sovereigns or half sovereigns, because for people who counterfeit gold and silver, they'll do it, they're not going to do it. They're going to do it for for bars, which are bigger and more valuable. But if you stick to the reputable dealers, they do test it. And they, for example, Gold Investments, they've been in business for 40 years, family run business. And I've never heard of them getting forged stuff that I know of. They might have, but I'm sure they'll be very careful and they test it before. Bitcoin, Bitcoin, yes. Bitcoin has been the problem with Bitcoin right now is that it's so hyped up, so frothy, and Bitcoin doesn't have the track record of gold and silver. Bitcoin hasn't been through a hyperinflationary collapse of currencies. It's only been around since 2009. So I'm not saying people shouldn't get Bitcoin or other cryptos. I have other cryptos too. I'm just saying you got to be careful. I would feel much more comfortable having, I sleep more soundly at night having gold and silver than Bitcoin, to be honest. And that's just my opinion. I'm not trying to stop anyone from doing anything they want. Lori Chiov says Federal Reserve is a criminal cartel. Yeah, not only the Federal Reserve, but all the major central banks. people talk about the OPEC, they always have a go at OPEC because it's an oil cartel, and most of them are Arab countries, so they always get slagged off. But the original really big cartel is the banking cartel, and the head of that is not the Fed, it's the Bank for International Settlements in Basel, Switzerland. That's the bank for the central banks. So and the heads of all the major central banks, they go there every other month for a few days, and they stay. It's like a hotel there. They have dinner, private talks, and they decide what they're going to do with money. uh Fantanaranja, you can trust Sprott, but not the system. That's the thing, because Sprott is within the system. Sprott has to access the LBMA probably, and if things seize up and the LBMA won't supply the silver, uh, Sprott could want to do as well as possible to get the silver, but might not be able to. So that's why I think it's, for us smaller investors, better to try to get it from our coin dealers or bullion dealers. SQRT9, who's the biggest silver enthusiast? Monaco 64, Billy. I think it's him, Billy. What happened to the U.S. stimulus? Well, I think it's going through the House. They're still trying to get it through Congress. Yeah, that could be a problem. That could take that could really hurt the asset markets, stock market. The Fed might have to step in and start printing, but I'm sure they'll get it through. They always do, be they Democrats or Republicans. Physical silver, do you think they'll ever make it illegal to own silver if the shorts become official? Well, you'd never say never, but I don't think there was ever a silver confiscation. I think that would be harder. That's why I think also it's better to own physical silver than the ETFs, because they might go in and really raid the physical that some of the ETFs hold. And I think the ETFs and their holdings are hypothecated many times over. So there isn't enough silver in this ETF world, nor enough gold, I think. That's why we need to be in physical. Global intelligence, Lord Rothschild is throttling Mario's live cast to keep us from hearing the truth. How's he doing that? Let's see how many. Oh, we got quite a lot of viewers, 829. I mean, up until a few weeks ago, on my normal Sunday live streams, I used to get 400 to 500 concurrent views, and I'm doing a live stream here. Oh, it's no buffering. Yeah, I'm doing a live stream here from, on a Thursday night, and I'm getting almost 1,000 concurrent views. Is it buffering? I see Daniel McKiskey here. He's got like a little buffering thing. Refresh your page. Yeah. Nancy K. I think we've had a depression for the vast majority of the population in the US, Canada, and Europe since 2008. I think they've been able to cover it up quite a bit, but now it's going to show up, and hopefully even the 1%, the people at the top, will get hurt too. SoCal Silver. Hey, SoCal Silver. Yeah, I just thought it would be important, SoCal, to make a video about the volatility in the U.S. Treasury market. It's very serious, and I think it's the most important financial market. Bond markets are a lot bigger than stock markets, and basically, bond markets is where companies, governments, um, individuals, local governments, corporations, where they borrow money. So we're seeing a lot of volatility because the cost of money is going up right now, and that's not a good sign. And it's what happened last year in March. So I just thought it'd be important to have like a live stream to warn people about this. Joe D, my handicap is kind of frozen. I haven't played since December because we've all the courses here are closed. But when I stopped playing, it was 6. But they've had a handicap change here. They've gone to the American system, and now it's 7. But it's not. It fluctuates between 5 and 7 the last few years. My handicap. Oh, it's buffering, SAC Media says. I don't know why. I mean, we usually don't have that problem. 1 ounce bars, 1,000 ounce bars unavailable. Well, that's interesting because that's the wholesale bars. Let's have a look where we are right now in the markets. So I'll bring this up here. So you see the 10-year yield is going back up here a little bit, is almost at 152. The high has been 161, and that's bad. The higher that goes, the worse it is. You can see here as well, a month ago, the 10-year was around 1%. So, and we're now at 1.5. That's a big move. What about the rest of the markets? Let's have a look. The Dow now is down. Thank you, Georgie M. Macross, super chat. Let's have a look at the general market. See, the gold is back down here a little bit. Silver, yeah, but the Dow is now down 500 points almost. So you see yields start going up, the Dow starts dropping. What about the talk that higher bond yields mean that gold will go down? Well, I think in a, let's say, a rising yield environment and not spiking yield like this, yes, maybe gold, and where also the little shorter term rates are higher and the Fed is like raising rates and tightening policy, rising interest rates are negative for gold and silver. But we don't have that situation. What we have is the Fed saying, like Powell and Brainard said yesterday, we're not going to tighten anytime soon. We're going to keep policy accommodative. Under those circumstances, it's really bullish for gold and silver. And what we're seeing here is investors worried about that accommodative. They're worried about real inflation. And that's why the yields are spiking. But Wall Street and the Fed and the major Keynesian economists, they're trying to fool people into thinking that this is reflation, that this is just a sign that the economy is going to pick up. But I think this is a sign of people losing confidence in the dollar. They're losing confidence that the Fed and the ECB, the Bank of England, all the other major central banks will never be able to really rein in their accommodation, that they're going to have to keep inflating forever. And inflating, I mean, creating money and credit out of thin air. So yes, as I've said many times, hold on tight to your physical gold and silver. Don't get thrown off the bull. Yes, this is not when you want to get out of gold and silver in this, even though you're going to be told by CNBC, Bloomberg, and the major networks and economists that, oh yeah, gold is not going to do well and stuff. Uh, and I could be wrong, of course, but I don't think so because, yeah, right now it's the inflate or die. It's still inflate or die. Keller Robert 80, thank you for your super chat. He says, keep them coming, we're listening. Gur Olgi from Norway, thank you. What is your magic number in 10 years before it will crash? Huh? Well, I told you 130 was important, and it was. I think 150, if we can't get back above 150, can't get back below 150, that's going to be very serious. And think for the bond market, you have to think of like sometimes when there aren't resistances, you think of like 175 or 2% or 2.25. But the real important rate, and I don't think the Fed, well, they might lose control. Back in 2011, 2012, we had the European sovereign debt crisis, and the bond yields for countries like Portugal, Italy, Spain, Ireland, and Greece, they went from like 1% to 7 or 10% in a matter of weeks and months. So I think this could be the environment that we're under here. So you could see the 10-year yield be above 2% next week from where we are here. So it's not even a matter of at which rate it will start to show that there's trouble. It's just the volatility and the spiking up that will show that there's trouble. Georgie McCross, thank you again. Do you know if premiums of 1,000 ounce bars are rising? Where can I check? What's a regular premium? I think, Chris Marcus, he covers silver. I cover silver quite a bit, but he really focuses on silver. I think last Friday he did like a panel on his channel, Arcadia Economics, Chris Marcus, and he had a lot of bullion dealers with him, and they're talking that the premium for 1,000 ounce bars were almost $1, which is per ounce, which is quite a lot, and that you had to wait like almost a month to get the bars delivered. But yeah, check Arcadia Economics. BTST, thank you for your super chat. Could you say hello to my 5-year-old Ava? She's a big fan of yours and also likes Bitcoin and gold. Oh, hi, Ava. Nice to see you, Ava. Keep stacking. And yeah, if you like Bitcoin, that's not a problem. I have a niece, a grandniece. Her name is Ava. I think she's about 4. Buffering big time. Okay. Yeah, I'm sorry. I don't know why it's buffering. I've got, I got the Ethernet cable on as well. Historically, crypto highwaymen, the gold silver ratio has been around 15-1. Yeah. Some people think it could go 1-1, like Big Swear thinks it could go the reverse, that you need 10 ounces of gold for 1 ounce of silver. I'm not too sure about that. I think we could see it go to 10-1 and then come back to 15-1. Historically, that's the natural market rate. So here we go. The Dow now is down 520. Gold hasn't really dropped further. It's 1772. NASDAQ is down 439. So Tim Jones, explain everything about bonds. Well, basically bonds, the bond market is where people trade securitized loans to governments, corporations, local governments. And the biggest bond market is the Treasury bond market, because the US is the biggest borrower in the world. And what's happened today is that the yield of US Treasuries has spiked higher. And what that means, the price is dropping because people are demanding more to lend to the Treasury, because they're seeing that the Fed is not going to stop printing money to allow the Treasury to keep, borrowing and spending, and people are starting to lose confidence. That's what I think is happening. And that will affect all other bond markets, corporate bond markets, local government bond markets, mortgage bond markets, student loan bond markets. And all that does is raise the cost of borrowing for the whole economy. And we know that the modern economy right now in the US and Western Europe, it's all based on credit. There's very little production. We borrow money to buy everything from Asia or other countries. So yeah, it's very important. And the bond market is many times bigger than the stock market. So now buffering. So I'm going to call it a night now, because I've said all I've had to about the bond market. And this is not like a Sunday live stream. I'm going to do it for less than an hour. We've been here for about 45 minutes. Thank you, everyone, for showing up for this impromptu, live stream. And I will make my video tomorrow morning, and I will update you on